Hello investors. Welcome back to our channel. Today, we are diving into the world of index funds, the hidden gems that are gaining tremendous popularity in the investing community. So, grab your notepads and get ready to unlock the secrets behind their rise to fame. Picture this, folks. You are on a quest to build a solid investment portfolio, but you are overwhelmed by the vast array of choices out there. That's where index funds step in, a smart and efficient way to navigate the complex world of investing. Now, you might be wondering, what exactly are index funds and why are they causing such a buzz? Well, my friends, let's embark on a journey of discovery together. Before I start with index fund, let me start. What is an index? Imagine you have a group of friends and you want to know how everyone is doing in school. Instead of checking each person's grades, you can just look at the group's average grade. That's what an index does. It gives you an idea of how a bunch of stocks are doing together. It's an easy way to see if things are going well or not so well for those stocks. Another example, let's say we have an index with 3 companies, Apple, Google, and Microsoft. When the index goes up, it means these companies are doing well. When it goes down, it means they are not doing so great. It's like a helpful snapshot that tells us how a group of stocks is performing overall. Let's take the S&P 500 as an example. It gathered 500 influential stocks, blending their powers into a single number. It is a magical number representing a group of stocks. It became a compass, guiding investors through stormy markets. And so, they used this index as a benchmark, a reference point, a key to unlock the mysteries of the financial realm. Index funds are like the unsung heroes of the investment world. They are a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average or Sensex or Nifty, etc. But what makes these funds so attractive? It's all about simplicity, diversification, and cost-effectiveness. First off, simplicity. Index funds are designed to be easy to understand and invest in. You don't need to be a financial guru to grasp their concept. It's like having a delicious buffet of investment options without the hassle of choosing individual stocks. Second, diversification. With index funds, you gain exposure to a broad range of stocks or bonds, spreading your risk across multiple companies or asset classes. It's like having a basket filled with a variety of tasty treats rather than putting all your apples in one barrel. And last but not least, cost-effectiveness. Index funds are known for their low fees compared to actively managed funds. They aim to replicate the performance of an index rather than relying on costly human fund managers. It's like getting a great deal on a delicious meal, maximum taste for minimum cost. Now, let's address the elephant in the room. Why are index funds gaining so much popularity? Well, my friends, it's a combination of factors. Firstly, the rise of passive investing. Investors are recognizing that beating the market consistently over the long term is a challenge even for seasoned professionals. Index funds provide a way to passively participate in the market's performance, aiming to match it rather than beat it. Secondly, the evidence speaks for itself. Numerous studies have shown that actively managed funds often struggle to outperform their respective benchmarks over time. This realization has led many investors to shift towards the more reliable and consistent returns offered by index funds. Lastly, the power of compounding. With lower fees and steady performance, index funds allow investors to make the most of their long-term investments. It's like planting a seed and watching it grow into a plant. Are there any variety in index funds? Absolutely. There is a wide variety of index funds available to cater to different investment preferences and goals. Let's explore some of the most common types. 1. Broad market index funds. These funds aim to replicate the performance of a broad market index, such as the S&P 500, Nifty, Sensex, Dow Jones Index, SGX Index, etc. They provide exposure to a diverse range of stocks across various sectors and market capitalizations. 2. Sector-specific index funds. These funds focus on a specific sector of the economy, such as technology, healthcare, or energy. They allow investors to target their investments in a particular industry they believe will perform well. 3. International index funds. These funds provide exposure to stocks or bonds in international markets. They can be region-specific, such as European or Asian markets, or they can cover a global ex-US portfolio. 4. Small cap or mid-cap index funds. These funds focus on stocks of companies with smaller or medium-sized market capitalizations. They offer investors the opportunity to invest in companies with growth potential and can complement a broader market index fund. We also have large cap index, gold ETF, silver ETF, equity momentum index, and many more. It's important to note that each index fund may have different expense ratios, tracking error, and investment strategies. Investors should carefully research and consider their investment objectives and risk tolerance before selecting the most suitable index fund for their needs. While index funds offer numerous benefits, it's important to acknowledge that there are a few potential drawbacks to consider before investing. Here are some common concerns associated with index funds. 1. Limited upside potential. Index funds aim to replicate the performance of a specific market index, which means they are designed to match the market rather than outperform it. As a result, if the index experiences a downturn or underperforms, your investment in the index fund may also be affected. 2. Lack of active management. Index funds are passively managed, meaning they do not have a dedicated team of fund managers actively making investment decisions. While this can be a positive aspect in terms of cost effectiveness, it also means that the fund will not make tactical moves to take advantage of specific market opportunities or respond to changing market conditions. 3. Inclusion of underperforming stocks. Index funds aim to replicate the composition of a specific index, which means they will include both high-performing and underperforming stocks within that index. This can lead to a situation where you are holding shares of companies that may not be performing well, thereby diluting your overall returns. 4. Lack of flexibility. Index funds are bound by the constituents of the underlying index, so they may not be able to exclude certain stocks or sectors even if they are expected to underperform. This lack of flexibility can be a disadvantage if you have specific preferences or investment strategies in mind. 5. Potential for over-concentration. Some market indexes are heavily weighted towards certain sectors or companies. By investing in an index fund, you may inadvertently over-concentrate your portfolio in those sectors or companies, which can expose you to additional risk if those sectors or companies face challenges. 6. Tracking error. While index funds aim to closely replicate the performance of the underlying index, there may be slight differences in returns due to tracking error. Tracking error occurs due to factors such as expenses, trading costs, and differences in timing when adjusting the fund's holdings to match the index. However, these differences are generally minimal for well-managed index funds. It's essential to conduct thorough research, assess your investment goals, and consider your risk tolerance before investing in index funds or any other investment vehicle. Understanding both the advantages and potential drawbacks will help you make informed decisions and build a well-diversified portfolio that aligns with your financial objectives. In conclusion, investing in index funds can be a smart choice for investors. It's like a smooth sailing ship, following the market's currents without the stress of picking individual stocks. So, let's set sail with index funds and embrace the power of the market. That's all for today's episode. Until next time, stay invested, stay entertained. This is Wealth Finmart signing off. Cheers! Mutual funds are subject to market risk. Please read scheme-related documents carefully.